Hello, everybody. This is Michael Carlin, president of Henry Einhorn Wealth Management, with your first quarter market outlook for 2020. This is the first market outlook of the year, is always most important, in my opinion, where we're really trying to set the table for what we're looking at throughout the calendar year. And for those regular listeners and for those new, you need to know that we're joined by Joe Taiber. Taiber Kosmala. Joe, good friend and a tremendous, tremendous resource to our firm, to our clients, to everything that we do. Joe, good morning. Great. Well, hey, Joe, if we're gonna try to get this done in a half an hour. I think this is mission possible. So without further ado, let's go ahead and dive right in. One of the things that became really apparent to me, I spent a lot of time reading Bank of America, JP Morgan, UBS, Citigroup's, Vanguard, everyone's market outlook for 2020. I can't recall seeing a year where there were people that were further apart on both sides, from this is going to be a disaster to this is going to be, we're looking great and strong for continued economic growth. Joe, do you recall seeing things where it's like this disparate between both sides?
Yeah, I guess I would agree with that. I guess, and it all depends on what you're looking at, right, or what they are looking at, because there's certainly a case to be made, on the manufacturing side, maybe for the glass half empty, but I think a lot of maybe more things on the glass half full.
Right. Well, it's interesting, and I look back at the past couple of years, and what was interesting is that there's been so much speculation that this was going to be the year that the market falls. We've been hearing that for a number of years, really, even since I recall, since the financial crisis. As soon as the financial crisis hit, the market was down terribly, and every year subsequent, it's like, oh gosh, this has got to be the year where things fall apart. And I looked at the hedging strategies, that worked. In terms of how do you protect yourself if the market goes down? Obviously, shorting's been the worst performing way to protect yourself, with an average annual return over the past 10 years of negative 20%. But even looking around, all the different multi-strats and market neutrals and option rate, it's been a really difficult place for that whole market neutral space. And the people that want to protect themselves and their portfolios, the best way that it has worked the past 10 years has been like a 60-40 stock to bond mix. But Joe, moving forward, do you think that there's other ways that we're going to be instructing people on how to protect their portfolios with alternatives?
I don't know. We as you and I have talked over quite some time, alternatives, just in general, we like to paint with a guilty until proven innocent brush, just because they're pretty expensive. And when you want diversification and you want protection, that's generally when it is the most expensive to get it. So we're a little skeptical. Hedge funds had one of their best years in many years, yet they once again underperformed the market just in general. So that 60-40 portfolio was up, basically close to 20% last year, which is its best, year since it's had just a regular vanilla portfolio since 1997. So we're a bit hesitant, given the relatively constructive view on looking for insurance right here. I think this was the same conversation most people were having at this time last year. And, the market just, all it did was go on to, increase by about 30% last year. So a bit of skepticism on insurance, but a big picture, pretty happy with how things look right now.
Yeah, and when I think about the way things are right now, Joe, I look at, the length of the duration of this expansion. 125 months, which is great, but you look at unemployment, and you can look at it measured a bunch of different ways, and U3, U6, you can look at it just not here in the United States, but the G7, the largest 7 countries in the world, and unemployment worldwide looks good, particularly here in the United States. Wage growth looks good, but it's not excessive. So it is hard. It's hard to be pessimistic in a consumer-driven economy when you've got jobs that are that robust and wages that are that they're improving, and it's hard without anything being out of control where you feel like, oh my gosh, how much longer can this roll? This feels like a controlled rate of growth where, again, it's hard for us to go and get short here, or it's hard for us to go and get cash heavy here without seeing other economic data points that are indicating, geez, this is time of trouble.
Absolutely. And we completely agree. And as we've talked several times over the past many weeks here, you and I, the number one, the true north, that we really try to always keep our eyes focused on is liquidity, sort of the liquidity backdrop. And yes, we've got a really robust housing market. Yes, we have a phenomenal and decades strong job market. But arguably most importantly, the liquidity backdrop, and what we mean by that is just overall liquidity in the market and the Fed and the like, very supportive here in the U.S., very supportive globally. So very much feeding into our constructive view. Yes, the cycle is long. 125 or 26 months consecutive economic growth, but it's not been it's of the top 10 longest expansions. In fact, this is the lowest in cumulative GDP growth. So it's been very long in duration in terms of the cycle, but it's not been, an inflationary high growth type environment, obviously, as well.
Yeah. And I think this, obviously you and I are singing for the same tune, and I add a couple of different elements, and I want to make sure we spend time on the Fed. But before we jump off of the consumers, it seems to me that the consumer balance sheet, with respect to what they have in their retirement portfolios, investment portfolios, as a percentage of their income's never been higher. Meaning consumers have more on their balance sheet than they've had. Really, you can go back all the way to the 50s, and this. So with an asset base that's strong, with job market that with wages that are strong, again, it's hard. It's hard to be pessimistic, even though there are some models that are, the J.P. Morgan model and others, where you're seeing that there were fears of recession creeping up in December. Those have subsequently come down significantly as well. So again, with that, and I want to dovetail this into the Fed, with the Fed helping push us forward. That's something that I don't think a lot of retail investors really understand. That we've got a Fed that's helping row the boat here. That's helping provide liquidity. That's helping provide stability to markets. And as long as the Fed is helping, it seems very likely to us that the market can continue to move forward. So there's kind of that tale of two cities. Is we have the Fed helping, but how does that look long term? Is this a good long term thing for the Fed to be doing? Because we can understand the benefit short term. But Joe, how do you weigh in, and how do you handicap this whole thing, where we can break down and explain the Fed helping, the Fed pushing, the Fed moving the economy along, and helping the stock market and helping the individual retail investor, retail consumer?
We think that is the number one most important thing. I mean, the killer of most market cycles is, in fact, the Fed. And typically it's a policy mistake on behalf of the Fed. So keeping a very close eye on the price of money, which they set, is very, very important. And they've been very clear this year about their intent to stay on the sidelines and make no rate hikes here in 2020. In fact, I think one anecdote of very much of interest is the Fed is really they're revisiting their strategic initiative, or their strategic goal. The number one goal of which is price stability. Another word for inflation, or keeping inflation modest at 2% target is what they are right now. But they're pivoting seemingly, and not formally yet, but seemingly pivoting to looking at their 2% inflation target from a context of over a business cycle, not just when inflation hits 2%, which, by the way, it hasn't. It's averaged 1.6% since 2008, and it's still there.
Right.
But the fact of the matter is, they've been very clear that they're going to stay on the sidelines and likely going to let inflation trend over 2%. Before they really start increasing the price of money, otherwise said hiking rates. And that just means that they're going to be on the sidelines and stay constructive, or friendly, I guess, market friendly, for the foreseeable. So I think that's a very important thing.
And I've seen Fed models that were put out by institutions like Vanguard, where they're showing that there's a possibility of further rate cuts in 2020. It's a little early to call that, but I'm interested to see how that comes together. And I also look globally, Joe, and globally, we did not have a global coordination of where central banks across the world were working together, and they have been working more together lately. So in 2019, there were less rate hikes globally, and there were a lot more rate cuts globally here in the United States, where we hadn't seen anything globally in 2017, 2018. The kind of central banks of the world sat on their hands, didn't do much. We've seen that start to change, and that has to be supportive not just here in the United States but all over the world.
Yeah, no question. I mean, the three central banks that you and I keep close eyes on are the Fed, obviously, the European Central Bank, and China, the three largest global economies, really, China, the U.S., and Europe. The ECB resumed quantitative easing in November of last year, November of 2019, after taking 10 months off. So they're back to a very accommodative stance right now. They have a new ECB head in Christine Lagarde right now that took over at the end of last year. But that's one, again, constructive. We've already talked about the Fed being constructive. And then lastly, the PBOC, the People's Bank of China, they too very much constructive. They made a significant cut at the end of last year in their banking system, injecting liquidity into their banking system. They lowered their benchmark lending rate also, and more cuts are expected, from the PBOC. So here you have the big three central banks, all of which, like you said, Michael, in addition to many others, leaning more, market friendly, I suppose. So,
well, and how can we highlight the Fed being market friendly without saying that we might have had the greatest and quietest liquidity boost ever? The Fed injecting more liquidity in the market ever since September of 2019. I'm telling you, Joe, clients are completely unaware of this until I mention it. So no one's aware that there were issues with cash deposits and, interbank lending, borrowing rates and lending rates, and that the Fed has stepped in and has provided tremendous liquidity to that part of the market, which to me, obviously signals that there's, there must be some lack of demand from international buyers of our paper. That could be a component, but my goodness, the Fed has stepped in such a way where if you thought that the Fed was doing a lot, post the financial crisis, take a look to see what they've done since September. So it's not a surprise to see the market performing well since September, especially given what the Fed has done and how it can positively impact people's and investors' in institutions' mood. But Joe, is this something we should be worried about? I guess that's the real thing that that we would want to break down. Is this something we should be concerned about the Fed, what they're doing?
Yeah, I think you might be referencing slide 13, which is a really fascinating chart that you're referencing there, Michael. It looks at just the parabolic spike up in total assets at the Fed, and you're right, it's all happened since September of 2019. There's some nuance here, and I won't get into any technical details here, but long story short, that was in direct response to a spike in overnight lending rates between banks here in the U.S. So overnight, very, very short-term lending rates spiked. There was a liquidity vacuum, and the Fed basically stepped in and filled that gap to the tune of $400 billion, which, by the way, is retracing over 50% of the quantitative tightening or the balance sheet reduction that they did all the way throughout the balance sheet reduction regime there. So $400 billion injected. The important thing, and the reason that the Fed calls this, quote, it's not QE, is because all they're focused on here is very, very short-term paper. Actual quantitative easing, they were buying intermediate duration or intermediate maturities and longer-term maturity treasuries and mortgages. Here, this liquidity injection is purely on the short term, the very, very short-term end of the market. So it can be viewed a little differently, and we think it's much less of a risk, a systematic risk, than an all-out quantitative easing. So are we concerned about it? No, we're not, in fact. We think it's more of a liquidity window that met a situation with regard to overnight lending in the banking sector. So it does look pretty concerning, but we aren't too concerned about it right now.
Right. So again, the takeaway here is as long as the Fed continues to participate, continue to help, continue to push that boulder uphill, then that's a good positive tailwind for the market continue to run higher. So the profit cycle, kind of the business cycle where we're at? I don't know. I saw, BlackRock had an interesting slide. And by the way, Joe referenced the slide deck. For those of you that know, you can always email us, reach out to us at Manage the Funds, or any one of our social media handles, Instagram or Twitter or others, to get the slide deck. Just let us know. We'll send it to you. But it's BlackRock indicates that we are, definitively late cycle. The thing meaning that we're kind of in that latter stages of economic expansion. What I was encouraged by BlackRock's research is that sometimes this cycle is pretty long. It's pretty long. So I say this because a typical investor hears, we're late cycle. I've got to get risk off now. I've got to sell right now. I've got to make a change in my portfolio. And I'm here to say, I concur that we are late cycle, but let's be encouraged by the fact that late cycle doesn't mean it's over by any standard. Does that make sense, Joe?
Yeah, it does. Absolutely. Late cycle, long cycle, no question about it. Well, I don't know about late cycle. We're mid to late cycle is the label that we would hang on it. I think from a market perspective, the thing to think about is really, I guess, the lens that we encourage clients to look at things through is, what time period are we really talking about here? If you're talking about the next, 1 to 3 months, you can make a pretty strong argument this market is overbought. Arguably extremely overbought. So putting new money to work, just acknowledging that there's potentially some short-term consolidation that can happen, but the longer-term trend and the true north of that longer-term trend truly is, do you see recession or an end of the cycle on the horizon? And that's where you have to come back to true north, which is the liquidity backdrop, monetary policy, and some of the economic and financial market indicators. And again, those I'd say are still relatively constructive.
Yeah, well, so we're aligned, but and we are being certainly very cautious with client cash capital that we're getting now at this point, and we are definitely have a different investment philosophy than we did at the beginning of last year. So Joe, did you happen to catch that Apple's market cap, the total value of Apple, is greater than the entire energy sector? Does that? Wait a minute. So that has to mean one of two things. So the fact that Apple's worth more than all the publicly traded energy companies combined, in my mind, means either energy is overdue for some type of a rebound, given the fact that it's struggled for so long, and it has. It's been a really rough road from 2007 to today, where if you look by some measures, the energy complex has lost half of its value over that time period. But doesn't it also maybe mean that, and Apple's gone up since I've gathered this data, and Apple's even gone up higher. But Joe, you can't have that. You can't have one a company that makes cell phones and iPads be worth more than all the publicly traded energy companies in the United States, right?
It's one of those things that it doesn't pass the smell test, as I like to say.
Right.
But and that's been getting a lot of headlines, Michael. And I'll tell you what, the one anecdote that we picked up just a couple of weeks ago is in terms of look at the market. This is basically talking about market structure, equity market structure, and the top-heavy nature of it, the top-heavy nature of your Apples, your Microsofts, your Googles, your Facebooks, the FANG stocks, as are often referenced. Those top 5 stocks are getting a lot of ink in the press. And how much of the S&P 500 that they represent is getting a lot of ink in the press. And one really interesting anecdote, in 2019, the top 5 stocks, in terms of their percentage of the overall S&P 500, was 16.18%. So 16%. Now, historical context. Okay, the same top 5 heaviest weight over the last 30 years was actually the tech bubble.
Yep.
Probably.
I saw that chart. Yeah. Keep going.
So that was 18.16%. So the high water mark is 18%. The current mark is 16%. The low water mark of the top 5 stocks as a percentage of market cap is 15%.
Right.
So we're actually somewhere in the middle of where the top 5 stocks in terms of percentage of market cap generally has been over the last 30 years, even though some, obviously a lot of headlines are latching onto that. So I think it's an interesting anecdote.
Yeah, and right, because sometimes this information is nothing more than just a good headline.
Yes.
Right. I want to remind everyone that you need to stay invested, and so periodically I find this same chart. The same chart where, the value of staying invested consistently is important. And one of the roles of your advisor is to make sure that you are staying invested intelligently as the market and economy do what it normally does. It goes through cycles. So here's I think this is an anecdote. This is data, but take a look at the previous 20 years from January 4th, 1999, to the end of the year 2018. You endured 2 massive market corrections, 2 massive dot-com bubble bursting in the financial crisis. If you just left your money alone, you started investing January 4th, 1999, which was one of the worst times to start investing. And you took it all the way through to December of last year, where, by the way, December of last year, the market was down another 20% that quarter. So you had the financial crisis, you had the dot-com, you had all these different things come. You would have averaged a 5.6% rate of return. Here's where it gets interesting. If during those pockets of times you said, I'm gonna take. I don't like where the market is or the economy is, and you end up selling over that 20-year period of time. If you happen to miss the best 30 days in that 20-year period of time, and you're gonna miss them because you don't know when they're coming, your return would have gone from 5.6 to negative. You would have averaged a negative 2.3% return, completely defeating the reason why you'd be investing to start with. Joe, we got to remind people to stay invested. And I'm not saying that for self-serving purpose. There's always a good place to be, but trying to pick pockets is impossible. There's no one that's been able to do it. So let's kind of keep your eye on the prize over the long term. Is there another way to look at this or say that?
Well, this chart absolutely paints the portrait of market timing is not a good idea. It's that simple, and the numbers tell the story. And just anecdotally, I mean, and we've shared this with you, your listeners, I'm sure over time, is we do navigate investment programs for pension funds and foundations and endowments, some institutional money and the like. And the reason that they stay invested is right here. You can't guess what's going to happen tomorrow, and you really can't. And it's a money losing venture over time. The important thing, though, is making some at the margin informed decisions, right. Which is what institutional investment programs attempt to do. And it's what clients of Henry Einhorn are receiving. Just intentional, informed, at the margin leans and tilts. To be able to play a little bit of defense when defense is warranted and a little bit more offense when offense is warranted.
Yeah, and in partnership with your firm, Joe, we've been able to do that better than ever. So again, I know I've thanked you recently, but I'm going to thank you publicly again. I sincerely appreciate your insights in helping, because we've had our portfolio performance. I mean, this is not a commercial, but my goodness, crushing the benchmarks. So thanks again for that. I would be remiss if we didn't spend just a minute or 2 or 3 as we start to wrap up the market outlook here, talking about the election. So I have a few things that I want to throw out there. The third year of any presidential cycle, the third year of that cycle, which was Trump's third year last year, is historically the best. Last year didn't disappoint us either. So before we get too excited about last year's performance, again, 2018 was terrible. So 2019 was a bit of a bounce back, and it was the third year of Trump's cycle. So you had a lot of tailwinds there, kind of helping push things forward. But then as we look forward, when you've got a president, when you got a presidential re-election year, the market tends to perform better when you got a presidential re-election year, as opposed to having an open election where you don't know. And when the incumbent party wins, because you're removing the uncertainty of what's going to happen next, the market tends to perform well there too. So Joe, I don't know. I look at this and I say, we're in a re-election year. We're coming off a 30% year. The economic numbers look good. If the incumbent party wins here, it just seems to me that there's again a lot of things to feel good about. So I want you to highlight that. Any comments on that? And at the same time, this is not to be political, and I'm not trying to tip our hand in terms of how we're going to vote personally or individually, But if there is some kind of change of guard, it historically speaking, the market can tend to sell off because of some of that uncertainty.
Yeah, that right there, Michael, I think is the key word, uncertainty. So, what markets do not like is that, and everybody hears that frequently, and this is case in point, uncertainty in terms of policy in the context of politics. And how the election goes is going to dictate fiscal policy more so than anything else. Monetary policy is dictated by the Fed. So fiscal policy, and I think this is important. I mean, the mitigating uncertainty of re-electing an incumbent is reflected in market returns because market participants and business owners and decision makers and the like have more clarity, and the policies over the past 3 years have been pretty constructive. The markets obviously voted accordingly, and those policies are more obviously of a deregulatory nature from an energy and financial industry and even healthcare perspective. So deregulation has been a big tailwind, I think, for financial markets. And from a spending perspective, I think things look a little bit less clear because I think both parties, frankly, the Democrats and the Republicans, both have a hard time finding spending restraint. So I think spending is going to happen no matter what. But any policy change, fiscal policy change, significant policy change, I would expect markets to get pretty anxious. But we still think there's plenty of runway in front of us here before we really are going to start handicapping election outcome and potential impact on markets, just because it's a little bit less clear on the Democratic side. There's centrist candidates that frankly probably won't look a lot different from a Republican administration on the Democratic side of the ticket. So we'll see certainly as we approach the spring and how that's starting to lay out. Yeah,
and there's a little secret formula in there that if you look at how the market return 3 months before the election, it doesn't always work, but it almost always works. If the market looks good 3 months before an election, then you usually see the incumbent party winning. So in conclusion, Joe, China looks good from the standpoint of we got trade deal 1, which as we're talking today, it looks like it's going to be signed. So we've got a lot of trade tensions that seem to be easing. We got trade tensions easing. You've got no immediate Brexit concerns right now. We've got USMCA trade deal signed. We've got low oil prices. We've got low inflation. We've got the Fed helping us in the economy. So as we sit here right now, in conclusion, things look constructively pretty good. This is not a time to fall asleep at the wheel. We're certainly not. We are always ready to get more conservative if the data points start to tip in any kind of negative or different direction. But for right now, things look okay.
Yeah, some of the political uncertainty you just mentioned, tariffs, European auto tariffs, the administration let that lapse actually in December as well. So the USMCA, European auto tariffs are temporarily, at least at a minimum, off the table. The Chinese deal obviously being signed, I think, today. And so some of the political things out of the way, monetary things, i.e. Fed and things of that sort, like we said, look very constructive. And the economic data points, service sector, job market, housing market, all great. Manufacturing cycle is something we're keeping an eye on, and but that's the only real glass half empty aspect on the economic landscape.
Thank goodness we're still service-based economy, not manufacturing mostly. But anyway, all right. So Joe, thank you again. Thanks for your friendship and partnership. Thank you again for listening. If you have questions, email us. Hit us up on social media. We're happy to help in any way. This has been Michael Carlin. That has been Joe Taiber. Thank you. Take care and have a great day. Material on this program is intended for general information only and should not be taken as specific investment, tax, or legal advice. None of the information contained in this broadcast is intended by the host to be a solicitation for sale of any security. Further information is available by contacting Henry Einhorn Wealth Management. Securities offered through Independent Financial Group, member of FINRA SIPC. Advisory services offered through Wealth Management LLC DBA Henry Einhorn Wealth Management, a registered investment advisor. Henry Einhorn Wealth Management and IFG are separate and unrelated entities. Henry Einhorn and Henry Einhorn Wealth Management are separate entities. Member of FINRA and SIPC.